Welcome, and our interest today is we are going to look at how we can prepare a manufacturing account, which was actually requested from one of the viewers. And from the information delivered, we have a trial balance of the various ledger accounts, which was extracted on 31st December. Of course, we can see the total of the debit side is equal to the total of the credit side. It means the entries that were made in the various ledger accounts were accurate. And maybe just to have an overview of what we are going to do, I want us to examine the meaning of a manufacturing account, which is actually prepared to determine the production cost. The production cost of a manufacturing entity. That is, we want to establish a particular business entity wants to determine which costs were incurred. And when you talk about various costs in a manufacturing business, we are talking about direct costs and indirect costs. Now, what about direct costs, also known as prime costs? These costs are directly related to a unit of production and so can be easily traced. They can be easily traced. It means that when a particular manufacturing entity has its final product at the end of the production, they can easily determine, they can trace back, they can work back, they can backtrack and actually find out the costs which were incurred throughout the production cycle until the finished good is processed. Remember, we have a production cycle. We can easily trace back and find out actually what took place with that. Those are direct costs. Then indirect cost cannot be easily traced back. This one cannot be easily traced back, and they don't directly relate to a particular unit of production. And for that matter, we have example to do with wages to factory casuals. When you pay factory casuals, we cannot easily attribute, because they do so many activities in the workplace, we can't really attribute the kind of effort that they put in the production. Of course, when you talk about factory rent, for example, factory rent, remember in the factory section or the premise, we have employees, we have the machines, the various types of assets. So we actually don't know which type or which asset are we paying for the rent. And for this particular case, it comes under indirect cost. Of course, we have so many examples like maintenance of factory forklifts and all that. Depreciation on factory plants and machines. We don't know actually which items led to the loss of value for this particular asset of the company or the business. Then let's now talk about prime cost. Examples here we have direct materials added to direct labor added to direct expense will give us what is known as direct prime cost. Now, when you talk about direct materials, we are referring to these tangible components of the finished product. Remember, when you have a product at the end of the production, we can easily determine which components make up, and those are direct materials. Also, we have indirect materials for that particular scenario. Then direct labor refers to the workforce which is directly put in the production process. Now, we have laborers, casual laborers, and we have managers, for example. Managers are not involved in the direct production, so they don't fall under direct labor. In fact, labor from managers is an indirect labor. We only involve those efforts, like examples are the assembly line workers. These particular people, they have to be in the production premise for this particular activity to be undertaken in the right way. Then you have direct expenses. They are incurred, they are associated with a particular cost, expenses incurred by a specific department. And for this matter, we are talking about expenses which a production department will incur. Now, when we talk about manufacturing accounts, we are going to talk about direct. We are going to talk about direct. We are going to talk about direct costs plus indirect costs. Of course, we have some other expenses like administration, selling and distribution, and finance charges. These ones will make part of the statement of comprehensive income. We won't include them in the manufacturing accounts. So our work is going to dwell on prime cost, which are the three costs. And when we talk about direct expenses, we have things to do with raw materials which have been purchased from the suppliers. These are the materials to be processed. We have things to do with the work in progress. Work in progress means those products which are still under the production process. They have not yet become part of the finished goods. And then finally we have finished goods, which is the final state of the product ready for consumption by the consumer. And of course we are going to factor in all these. Work in progress and raw material, they make part of the manufacturing account. While finished goods, they will be involved in the statement of comprehensive income, because actually you sell your finished goods to get a profit. So we will under the income statement, we normally compare the sales with the finished cost of finished goods to find out whether the business made a profit or made a loss. Up to that, we now have the frame of what we are going to do. Now I want us to examine the question. And from this one, we have the additional information like inventory of raw materials on 31st December. It means this is the closing inventory of raw materials. So we are going to factor in that one. Inventory of finished goods, that is 40,000. Then work in progress as at the closing period is 15,000. Then lighting, rent, and insurance are to be apportioned in the ratio of 5 to 6. Now it means that we are going to adjust the values for lighting and the values for rent and the values for insurance. It means we won't use the values which are given here. Remember, this one is administration. We won't deal with it because it only forms part of the income statement. So when we make adjustments for lighting, you can see for lighting we make adjustment for lighting and see which value are we going to transfer to the manufacturing account. Like it is 10%. I mean, it is lighting should be here. Lighting is rent. Lighting should be 5/6 times this value here, which is 7,500, and what we get is 6,250. Then rent is again 5/6 times the value of rent we have here is 1,200. So 5/6 of 1,200 we get 10,000. Then finally we have insurance, which is 5/6 again times the value given in the books, which is 4,200, will give us 3,500. Now these are the adjusted values for this particular entity. Then we begin by now looking at how to do the question. Every particular business will normally have what is known as opening inventory. Like we have opening inventory of raw materials, and the value given here, you can see the value given here is 21,000. So we write it here, that is 21,000. Then we are supposed to add, something to do with the purchases, because purchases were bought on the first day of this accounting period. It was bought on 1st January before this date. Open inventory means they were carried forward from the previous period. So when we add this one, we will now have which amount of raw material is available to be sold. But remember, we normally have some adjustments which can normally affect purchases. Like in this case, we have carriage inwards, an amount of 3,500. So we're supposed to add carriage inwards on raw material. This is purchases of raw materials. Now, what is carriage inwards? Carriage inwards means the transportation cost which is incurred when the raw materials or when the purchases are being brought into the business. And of course, the value of the purchases was 370,000. We add the transportation cost of those particular materials, which is 3,500. So when we add whatever we opened the period with plus what we have purchased and the cost incurred in purchases, we are supposed to get 394,500. Now, what is this value? This value means the cost of raw materials which are available for consumption. So it is the cost of raw materials available for consumption. Consumption here means this is the cost of what is available to be undertaken under the production process to enable the business to realize whether there will be a profit. They are supposed to be consumed in making the finished goods. So this is what the business has. And then we are told that at the end of the accounting period, that is 31st, the inventory of raw materials was 24,000. Now, what does it mean? It means that some value has been consumed, so we get the difference. So it means we are supposed to less the closing inventory of raw materials, what remains at the end of the date. And when we do that one, when you less 24,000, what remains is 370,000. Now, what is this 370,000? It means it is the cost of raw materials consumed. What was available is this one at the start of this period. Then we remain with this amount at the end. It means what you have consumed is this. So this one becomes the value of cost of raw materials consumed. After that, we are done with the direct costs. These are direct costs. Then we are supposed to add, remember, we are now talking about the prime cost. And I said prime cost is direct material plus direct labor plus direct expenses. So we are supposed to add anything to do with direct labor. And direct labor, from our question, we are told that wages, the direct amount of wages is 180,000. That is without adjustments. So we are supposed to add it. Direct wages, we have 180,000. Then anything to do with direct wages, we talk about things to do with royalties. Again, we have royalties. that is the production royalties. You can see here we have production royalties. And what are royalties? Royalties means the rights to use a particular resource. Now we are supposed to pay for that because that is a labor which will be used. Now these royalties are normally paid to the particular people who are involved in the extraction of the raw materials, and the value of the royalty here is 7,000. So we add 7,000. Then because we don't have any direct expense, from this, because after that we have general expenses which are indirect, we are going to arrive at what is known as the prime cost. Now when we add these three, we are supposed to get 557,500,000. Please confirm with me. Now this is now the value of the prime cost. We have now added the direct material, direct labor, and direct expenses. Then remember I said, for us to get the manufacturing account, we normally add direct cost plus indirect cost. So direct cost I already worked out. Let us talk about the indirect cost. And indirect cost here we said they refer to the factory cost. So anything to do with the wages to factory casual, depreciation, maintenance, they fall under the indirect cost. So we add all the indirect costs. So we add indirect costs. And one of the indirect costs that we have is general expense. General because we cannot attribute what actually led to the cost being incurred. So we have general expense without adjustments, 31,000. We have general expenses. We have 31,000. 31,000. Then after that we have lighting. Remember lighting, we made an apportionment and we are talking about 6250. So lighting we have, and it is normally in order to mention the apportionment in your working, which is 6250. Then we talk about the next one is factory power. The power, because there is no apportionment for power, we simply add the value of power, which is 13,700. 13,700. These are all the indirect expenses or indirect costs. Then let's talk about, now this one will make part of the income statement. They are not involved directly in production. Sales, they don't involve in the production. Commission or sales, again they don't involve. Then we have rent, so these three won't involve. Then we have rent. Rent was an amount of 10,000 after adjustment. The apportionment. Then let's talk about, after that we talk about insurance. So insurance is supposed to be an amount of what we found out was 3,500. Then we go to depreciation. After that we have general administration, that is under, they're not involved in direct production. Bank charges are not involved in direct production. Discounts allowed, not direct production. Sales, no. Account receivable, no. Bank cash, so all these ones they don't involve. Remember we had some adjustment for depreciation, and when you talk about depreciation, we are told that depreciation on productive machine is to be apportioned at 10%. And remember, we have the value of productive machine as on cost is 280,000. So it means we get 10% of that, which is supposed to be 28,000. So we are supposed to add depreciation on machine. And why do we add this depreciation as indirect expense? Because we don't know actually which items lead to the loss of value for these particular machines. Then finally, we talk about indirect labor. Remember, here we have indirect labor under the wages. So we add again indirect labor. Indirect labor, which is supposed to be, the value is 145,000. 145,000. When you add all indirect costs here, we are supposed to arrive at a value of 237,000 for 50. 237,450. And remember, we are talking about now manufacturing. We are looking at manufacturing account, the expenses incurred. So it means we are supposed to add these two to get a value to do with 794,950. That one, we are now done with the direct cost and in the direct cost. And I said we have some element to do with work in progress. Goods which are still under production, they bear some cost, and the cost borne by these particular goods are supposed to be factored in. So it means we are supposed to add the opening work in progress, and the value of the opening work in progress as per the question is 13,500. 13,500. Okay, so we're supposed to have 13,500. We less closing work in progress. We want to get the value of the products that were still under production facilitation, so that you can be able to know the cost which will be adding to the other cost. And the closing work in progress we were given as, it was inventory, it was 15,000. The work in progress on 31st December was 15,000. So when we less this 15,000, you can see there was there was some cost incurred. When we less this, now we have the opening work in progress with 13,500, closing work in progress of 15,000. It means the difference between the two, which is 1,500, is a cost which has not already been incurred. In other words, this cost is still pending in the manufacturing business. It will only be added to make part of the cost if the amount of those products have been made to their finished goods. So we're supposed to subtract this cost from 794,950, which is actually the summation of the direct cost plus summation of indirect cost. So when we less this from these, we're supposed to get 793,450, and this value that we arrive at is known as, it's supposed to be given a denotation of production cost of finished goods. This cost of finished goods of an amount of 793,000 will be transferred, it is carried down to the profit and loss account. Now this one will make part of the income statement. We are going to see that later.